Hello everyone and welcome to The Explainer. Today we're going to take the very first and maybe the most important step in understanding your money. We're going to learn all about rates and returns.
Namaste everyone. Welcome to your first class. Now I know many people think finance is very complicated, but I'm telling you, the basic ideas, they are actually quite simple. And if you can understand those, everything else will just fall into place. So shall we begin?
Let me start with a simple question for you. Have you ever wondered, if you put 100 rupees into a savings account and you come back next year, it has become maybe 104 rupees? Where does that extra 4 rupees just appear from? That simple question is the key to everything we will learn today.
Well, that extra money, it comes from something called an interest rate. Just think of it like this. It is a reward. It is the reward you get for being patient, for not spending your money today and waiting until tomorrow.
Now, in the finance books, they have a proper definition for this. They call it the interest rate. It's the minimum reward or return that an investor needs to receive before they are willing to give their money. It's their price for waiting, you see.
To make it even simpler, think about rent for a house. When you live in someone else's house, you pay rent, isn't it? Well, interest is exactly the same. It's the rent you pay for using someone else's money. Simple, no? But what is this price of money made of? Just like when you buy a train ticket, there is a base fare. And then there are so many other charges added on top, right? An interest rate is not just one number. It is built from several different parts. So this interest rate has 5 key parts. You have the base fare, we call that the real risk-free rate. Then you have extra charges for different kinds of worries. What if prices go up? What if someone doesn't pay you back? Now, don't worry about memorizing all of these names today. We're just going to focus on the one that affects all of us the most, the price rise charge.
This price rise charge, it has a special name. We call it the inflation premium. It is just some extra money that is paid to an investor to protect them from a simple fact of life, that things generally get more expensive over time.
Let me give you an example that we all love. Today, a hot, tasty vada pav costs 10 rupees. But next year, because the price of potatoes, the bun, everything goes up, maybe it will cost 11 rupees. Your money needs to grow by 1 whole rupee just to buy the same vada pav. That loss of buying power, that is inflation.
So, a quick question for all of you. If everyone expects prices to rise very fast next year, should this inflation charge be high or should it be low? You would need a bigger reward to protect your money, so of course, it should be high. Excellent, you are getting it.
Okay, so we understand the price of money. Good. But when we invest, how do we know if we are getting a good price? How do we measure our gains? How do we keep the score? Every investment needs its own scorecard, right?
The simplest scorecard is called the holding period return. Now don't worry about the big name, it just measures the total return you earned on an investment, everything over the specific time you held it. It could be 1 day, 1 month, or even 5 years. Think of it just like a cricket batsman's score. The price you paid for the investment, that's the score when he started batting. The price you sell it for, that's his final score. And if the investment paid you any income in between, like dividends, those are like extra bonus runs. That is all holding period return is. Now, what if you have the score for many years? How do you find the average? This is very important. Let me tell you a little story about a shopkeeper, and this will show you why there is more than one way to find an average. You see, there are 2 main types of averages. One is the simple average you learned in school, the arithmetic mean.
The other one is called the geometric mean, which shows the true compounded growth. One is good for guessing the future, the other is perfect for knowing what really happened to your money in the past.
So, here is our shopkeeper. In the first year, business is fantastic. He doubles his money, a 100% gain. But in the second year, business is very bad, and he loses half of it, a 50% loss. Now, the simple average return is plus 25% per year. That sounds good, no? But wait, let's think. Is he actually any richer?
Let's look at his account book. He starts with 100 rupees. A 100% gain brings him to 200. Very good. But then a 50% loss on 200 rupees is a 100 rupee loss. So he's right back where he started. The simple average lied to us. His true compounded growth, what the geometric mean shows us, was 0.
Okay, for our final topic today, we'll look at something very, very crucial. It's the difference between the return a fund manager reports and the return that you, the investor, actually get in your own pocket.
It all comes down to asking the right question. The money-weighted return answers the question, how did my money do with all my deposits and withdrawals? The time-weighted return answers a different question. How skilled was the manager if we just ignore my actions?
You see, your money-weighted return, that is your personal report card. It is affected by your decisions. If you are very lucky and you add a lot of money right before the market goes up, your personal return will be very high. It really depends on your timing.
So how is the manager's return, this time-weighted return, calculated? Don't worry, it's a very logical 3-step process. First, you break the total time into smaller periods. Every time money is added or removed, you make a new period. Then, you calculate the simple return for each of those small periods. And finally, you link them all together, just like we saw with the geometric mean.
And this is exactly why professionals use the time-weighted return to judge a manager. You see, a manager controls where to invest, but not when you give them money or ask for it back. So this method measures only what they can actually control. It is the only fair way to do it. Very logical, isn't it?
So today, we've seen that an interest rate is just the price of waiting, that averages can be very deceiving, and that the return a fund advertises might not be the return you actually get. So my question for you is this. Now that you know the difference, which return truly matters for your own financial future? The manager's scorecard or yours? Think about it. Thank you for joining.
Hello, everyone, and welcome. Today, we are going to learn the first and I think the most important secret of money. You know, if you understand this one simple idea, everything else in finance becomes so much easier to understand. So, come on, let's begin our journey together. Okay, to start, I have a very simple question for all of you. Just imagine I am offering you a choice. I can give you 1,000 rupees right now, today, or I can give you the very same 1,000 rupees, but you'll have to wait 1 year to get it. So, which one would you choose? I am sure most of us would say, give me the money today. But the really interesting question is, why? Why do we want the money today?
Well, the answer is in this golden rule of finance. It says, a rupee today is more valuable than a rupee tomorrow. This one sentence, beta, is the foundation for almost everything. Why? Because the money you have today, you can use it. You can put it in a bank and earn interest, right? Also, who knows? Maybe next year things will be more expensive. So let's find out exactly why this is true. To understand this rule properly, we need to learn our first important term. It's called present value, or just PV. Now don't worry, it sounds very technical, but the idea is very, very simple. Present value is just what is the value of some future money right now in today's terms. Simple, right?
Let me give you a simple, everyday example. Think about booking a train ticket.
You pay the money for the ticket today, but your journey might be next month. That money you pay today, that is the present value of that future train journey. You see? You are giving money now for something you will get later. So let's do a quick check to see if we are all following. A quick question for you. If someone promises to give you 100 rupees 1 year from now, is its present value, its value today, more than 100 rupees or less than 100 rupees? Think about our golden rule. Of course, it has to be less. Very good.
Okay, to make this crystal clear, let's look at a real-world example. We're going to look at something called a Government of India bond. This will show us present value in action.
Right, so imagine the government promises to pay you 100 rupees, but 20 years from now. A long time. So how do we find out what it's worth today? We follow some simple steps. First, we know the future amount, which is 100 rupees. Then, we use something called a discount rate. Don't worry about the name, just think of it as an interest rate that helps us compare money over time. For this bond, the rate is 6.7%. Then, we do the simple math, and we get the present value.
And look at the result. It's quite surprising, isn't it? That 100 rupees that you'll get in 20 years is only worth about 27 rupees today. Just think about that for a second. This really shows how powerful our golden rule is. Money's value really does change over time.
This is exactly why present value is so important. It's the key to figuring out the value of anything that promises to pay you money in the future. And, the two most common things that do this are bonds and stocks. So let's quickly understand what these two are.
First, let's talk about bonds. A bond is, at its heart, just a simple loan. That's all. When you buy a bond, you are basically lending your money to a big company or even to the government. And in return, they give you a written promise that they will pay you back in the future with some extra money as interest. Think of it like this.
Imagine your local shopkeeper, your Kirana store uncle, needs 100 rupees for his shop. You give it to him, and he writes on a piece of paper, "I promise to pay you back 110 rupees in 1 year." That little note he gives you, that promise, that is basically a bond. Simple.
Now, let's look at stocks. A stock is totally different from a bond. When you buy a stock, you are not lending money. No, you are actually buying a small piece of the company itself. You become a part owner, a malik, even if it's a very tiny part.
Let's use a cricket example. Imagine you own a tiny pot of your favorite IPL team. Now, if the team plays well and wins the tournament, they get a big prize money, right? Because you are an owner, you will get a small share of that prize money. That small share of the profit that you get, that is called a dividend.
So, what is the main difference? Let's quickly compare. Buying a bond is like giving a loan. It's generally safer because you are promised a fixed payment. Buying a stock, on the other hand, is like being an owner. It can give you higher rewards if the company does well, but it's also more risky. Because if there are no profits, you might not get any dividend.
So how does all this connect back to our first lesson on present value? Well, it's very simple. The value of a stock today is basically the sum of all the future dividends you expect to get from it, but calculated in today's money. To find what a stock is worth now, we have to find the present value of all that future income. You see, it all comes back to our golden rule.
And for a good company, you expect these dividend payments to grow bigger over time. Look at this example here. In the first year, the dividend is 1 rupee 50 paise. The next year, it grows to 1 rupee 59 paise and then to 1 rupee 68 paise.
Do you see how those future payments are growing? Now, the important thing to remember is that each of those future payments, the dividend in year 1, in year 2, and in year 3, each has its own present value today. To find the total value of the stock, we would calculate the present value for each of them and then add them all together. It's the same powerful idea, just used again and again.
Okay, so this is all very interesting theory, but you must be asking, Sir, how does this actually help me in my life? Well, let me tell you, understanding this concept is like getting a financial superpower. Really.
You see, once you truly understand that the value of money changes over time, you can make much smarter choices. You will understand how a bank loan and its EMIs work. You can plan better for your future goals, like saving for a new phone or for college, because you will know that the money you save today needs to grow to be enough for tomorrow.
So please, beta, always remember this one thing. This simple idea that a rupee today is worth more than a rupee tomorrow is the true foundation of all finance. And the best part is, now you understand it. You have learned a very important financial secret today.
So, I will leave you with one final question to think about. Now that you have this knowledge, this financial superpower, how will you look at your own money differently? How will it change the way you think about spending or saving or investing starting from today? Think about it. Thank you for listening.
Namaste, students. Today, we are going to learn something very, very important. Something that will help you your whole life, not just in your exams. We are going to learn how to make friends with numbers. Yes, especially the numbers you see in finance and, well, in investing.
Now I know, when you see a page full of numbers, it can feel a little scary, no? Don't worry, Beta. I promise you, by the time we are finished today, these numbers will not be your enemies. They will be your friends. Friends who tell you fascinating stories. So are you ready? Cello, let's begin.
Okay, just think about a cricket match. You look at the scoreboard, and what do you see? So many numbers. Runs, wickets, overs, the run rate. It looks so complicated, doesn't it? But you understand it. Why? Because you know what each number means. Well, financial numbers are exactly the same. They're just telling a story. We just need the right tools to, understand that story. All right, so let's open up our special toolkit. Our very first tool, tool number 1, finding the center. We're going to ask, where is the middle of all the numbers? Now, the first way to find this center is something you already know, I'm sure of it. We all call it the average. That's it. In statistics, we just give it a slightly fancier name. We call it the arithmetic mean. And how do you find it? You just add up all the values and then divide by how many values there are. So simple. It's just like a cricketer's batting average. Let's take the great Sachin Tendulkar. In 3 matches, he scores 50, then a wonderful 100, and then, oh no, he gets out for 0. So what is his mean score, his average? Well, we just add them up. 50 plus 100 plus 0. That's 150. And we divide by the 3 matches. So 150 divided by 3 is 50. Simple, isn't it? Okay, so that was the mean. But there's another way to find the center. It's called the median. And this one might be even easier. All you have to do is arrange your numbers in a line, from the smallest to the largest. And then you just pick the number that is exactly in the middle. Imagine this, okay? 5 of you students are standing in a line, and you've arranged yourselves by height. The student who is standing right in the middle, that student's height is the median height. Now here is the important part. What if the tallest student is super tall, like Amitabh Bachchan? Does it change who is in the middle? No, not at all. And that's why the median is so useful. It's not affected by one very, very big or very, very small number.
And now for our third tool for finding the center, the mode. And I promise you, this is the easiest one of all. Really. The mode is just the number that you see the most often in a set of data. It's the most frequent one, the most popular number.
Think about your local shopkeeper, your kirana wala. Let's say he checks his sales for the day. He sold 20 packets of milk, 10 bars of chocolate, and, look at that, 20 packets of biscuits. So the number 20 appeared most often, right? That makes 20 the mode. It tells him what his most common sale number is. Very useful for him.
Okay, a small test for you now, my dear students. If your marks in 3 tests are 10, 5, and another 10, what is the mode? Just think for a moment. Which number appears the most? Yes, you got it. It is 10. Shabash. Very good.
Okay, so we're getting tool number 2 out of the box now. It's called measuring the spread. Because you see, knowing the middle number is good, but it's only half the story. We also have to ask, how far apart are the numbers?
Let me show you why this is so important. Imagine 2 batsmen. Both of them have the same average, 50 runs. But look at how they score. The first batsman is Mr. Consistent. He scores 50, 50, and 50. Very reliable. The other batsman, he is Mr. Unpredictable. He scores 0, then a huge 150, and then 0 again. See? They both have the same average of 50, but their stories are so different, no? This difference, this is the spread.
Now, the main tool we use to measure this spread has a very big, scary name. It's called standard deviation. But don't you worry about the name. All it is a number, just one number, that tells us how much the data is spread out from the average. If the number is small, the data is all close together, very consistent. If the number is big, the data is all over the place, very unpredictable.
I have a perfect example for you from your own kitchen. Think about the price of salt. It doesn't really change much, does it? It's stable. It has a very small standard deviation. But now, think about the price of onions. Oh my goodness. One month it's cheap, the next month it's so expensive you can't even buy it. The price goes up and down, up and down. It has a large standard deviation.
So let me ask you a question. For your household budget, which one is riskier, the salt or the onions? The onions, of course. The one with the bigger spread is the bigger risk. See? A large standard deviation means more risk. Samachke? You understood? Excellent!
Fantastic. Now for tool number 3. We're going to be understanding the shape. So we've found the middle, we've measured the spread. Now we ask, is our data balanced or is it a bit lopsided?
So look here. On one side, we have what's called a positive skew. This is where you have lots of small numbers and then a few really, really huge numbers. The tail, as we call it, is on the right. And on the other side, we have negative skew. This is the opposite. You have lots of small gains, maybe, and then a few, very big, painful losses. Here, the tail is on the left.
Let me give you an example for positive skew. Think about movie ticket sales. Most days, the cinema hall has, normal sales. But then a blockbuster movie comes out, and suddenly the sales are huge. These few huge days pull the average for the whole year way, way up. That's a positive skew.
All right, we've reached our 4th and final tool for today. This one is all about how numbers move together. So we're going to ask a very interesting question. Do 2 different things have a connection?
And the tool for this is called correlation. Basically, it's a way to measure the relationship between 2 different things. It shows us if they tend to move together, or if they move in opposite directions, or if there's no connection at all.
It's actually quite simple. Look at positive correlation. This is when one thing goes up and the other thing also goes up. Like on hot days, what happens to ice cream sales? They also go up. Then you have negative correlation. That's when one thing goes up and the other goes down. For example, when it rains a lot, do people go to the park? No. So more rainy days means fewer visits to the park. Simple, no?
Okay, now everyone please listen to me very, very carefully. This is probably the most important rule in all of statistics. Just because two things move together, it does not mean that one thing causes the other. For instance, in summer, ice cream sales go up. And sadly, sometimes crime rates also go up. Does this mean eating ice cream causes crime? No, of course not. It's the hot weather that is affecting both things. So you must always remember this. Correlation is not causation. And just like that, you have your new financial toolkit. Look at what you have learned. You know how to find the center, using mean and median. You can measure the spread with standard deviation. You can understand the shape, the skewness, and you can see connections with correlation. Wonderful.
So you see, the numbers, they are not so scary after all. They are just storytellers. And now you have the tools to understand their language. So I leave you with a question. Now that you have this wonderful toolkit, what story will you try to find in the numbers all around you? Go on, be curious. The stories are just waiting for you to find.
Namaste students. A very warm welcome to all of you. Today, we are going to have our very first lesson in understanding the special language of finance.
You know, sometimes it can feel that way, with so many big, complicated words. But I promise you, it's not a secret at all. It's just a new way of thinking. And today, together, we are going to learn a few of its most important words, nice and slow, one step at a time.
So, here is our lesson plan for today. First, we'll talk about making smarter guesses. Then, we will learn about what to expect. After that, we'll see how to measure risk and surprise. We'll also see what to do when the situation changes, how to learn from new information, and finally, we'll put it all together in your first financial toolkit.
We all love cricket, don't we? Of course we do. Now, whenever a great batsman comes to play, we all start guessing. How many runs will he score today? In finance, it's actually very, very similar. We try to guess things like a company's future earnings, but instead of just guessing from our heart, we use special tools. And the most important thing to remember is that this is not magic. No magic tricks here. It's all about using some simple but very powerful ideas to help us when we are not sure about the future. So, are you ready? Let's learn our very first tool. Okay, our first tool has a very fancy name. It's called expected value. I know, it sounds very big, but the idea is so simple. It just means finding the most likely thing that will happen. It's like finding an average, but a special kind of average called a weighted average. Let me explain with an example.
Okay, imagine a shopkeeper in your neighborhood. Let's say 90% of the time he sells a 10 rupee biscuit. And only 10% of the time, he sells a big 100 rupee cake. So, if you had to guess, what is his expected sale? Is it going to be closer to 10 rupees or closer to 100 rupees? Of course, it is much closer to 10 rupees because that is what happens most of the time. That simple idea, that is expected value.
Now let's use this idea for our cricket example. We look at a cricketer's history. We see there's a 15% chance he will score a century, a 45% chance he will score 50, and so on. Now to find his expected score, we just multiply each score by its chance of happening, and then we add them all up. So we take 100 and multiply by 0.15, plus 50 multiplied by 0.45, and so on. See? Simple, no? Now let's take this same idea and apply it to a real company. Let's call it Bank Corp. Now, instead of cricket runs, financial analysts are looking at something called earnings per share, or EPS. It's just a simple way to see how much profit a company makes for each share. And look, they do the exact same math we did for the cricketer, and they get an expected EPS of $2.34. So, a quick question for you. What is this expected value a good measure of? Is it the highest possible result, or is it the most likely average result? Exactly. It is the most likely average outcome we can expect. Well done.
Now, knowing the average is very good, but it is not the whole story. Not at all. We also need to know how different the actual result can be from our average guess. How much can it vary? And for this, we have our second tool, which is called variance. It's a wonderful tool that helps us measure risk and surprise.
To understand this, let's go back to our favorite game, cricket. Imagine two batsmen, Rahul and Rohit. Now, both of them have the same average or expected score of 50 runs. But look at them. Rahul is very consistent. He always scores around 50, 48, 50, 52. Very little surprise. But Rohit? Oh, Rohit is very risky. He might score 100 or he might get out on 0. Big surprise, no? So we say that Rohit has a high variance. He is more unpredictable.
Now, the calculation for variance looks a little complicated, but the idea is simple. For each possible result, we just measure how far away it is from our expected average. That's all. The final number we get, the variance, it gives us one single number to tell us how spread out or risky all the possibilities are. A bigger number means more risk, just like our risky batsman, Rohit.
Okay, another little question. If something has a high variance, does that mean it is more predictable or less predictable? What do you think? Yes, exactly. It means it is less predictable. High variance means more risk and a bigger chance of a surprise. You are all learning so well.
So far, our guesses have been based on just one situation. But what if the situation changes? What if we get some new information? Well, then our predictions must also change, no? This very important idea is called conditional probability. Our guess is now conditional on some new fact that we have learned.
For example, let's go back to our company, Bancorp. Its profit really depends on what is happening in the whole country's economy. So here, we see there are two main possibilities for the future. Interest rates could go down, or they could stay stable. There's a 60% chance they go down, and a 40% chance they stay the same. This is new, very important information for us.
And now, look at how this new information changes our guess. Remember our original expected value? It was $2.34. But now, if the interest rates go down, our new, smarter guess becomes $2.48. And if the rates stay stable, our guess drops down to $2.12. See how our guess gets better?
So let me ask you, does getting new information, like this news about interest rates, does it help us? Does it make our guess better or worse? Of course it does. It makes it much, much better. In finance, new, relevant information always helps us make a more accurate, more refined prediction.
This brings us to our next amazing tool. How do we properly, mathematically, update our beliefs when we learn new things? Well, for that, there is a very powerful and logical tool called Bayes' formula. It's like magic, but it's pure logic.
Let's take another company. Let's call it DriveMed. Now, based on our first little bit of research, we believe there is a 45% chance that its profits were better than what everyone was expecting. This 45%, this is our first guess. It's a good start, but we can do better.
And then we get this piece of news. The company says it is building a bigger factory because its sales are so high. Now, just use your common sense. What do you think? This news, does it make it more likely that their profits were good or less likely? More likely, isn't it? It just makes sense.
And your common sense is absolutely correct. Bayes' formula just gives us the mathematics to prove it. It takes this new information and it updates our guess. And look at this. Our belief jumps all the way from 45% to a much more confident 82.3%. We have used new evidence to make a much, much smarter guess.
And that brings us to the end of our lesson. So let's just take a moment to quickly review the powerful new tools that you have added to your financial toolkit today. You all have done so well.
Today, you have learned 3 very, very important things. Number 1, you learned how to use expected value to find the most likely result. Number 2, you learned how to use variance to understand the risk and the surprise. And number 3, you learned how to use the amazing Bayes' formula to update your guess whenever you get new information. You have taken a very big, very important first step in learning this new language of finance. And remember, these are not just ideas in a book. They are real tools that you can use. So the real question is, now that you have them, what will you try to understand next? The world of finance is now a little less of a secret and a little more open for you. Well done, class.
Hello, everyone, and welcome. Today, we're going to learn something very important in finance: how to build a smart investment portfolio.
Namaste, students. Now, I know when you hear these big, heavy finance words, portfolio variance, covariance, it can feel a little scary, no? Don't you worry. Today, our job is to make all of this very, very simple. I promise you, by the time we are finished, you'll see it is not so difficult.
And how will we do this? We will understand everything by using something we all love. Cricket! Yes! Imagine you are the captain and you have to build a winning team. Every investment is one of your players. So, are you ready to become a captain? Let's begin.
Okay, so let's start. What is the very first job of a captain? It is to pick the players, of course. And when you are looking at a player, what is the first thing you want to know? You want to know how many runs can he score? This is what we call reward. So, in finance, we have a name for this expected score. We call it expected return. It is nothing more than the player's batting average. Simple, right? If a batsman's average is, say, 50, then we expect him to score about 50 runs. That's it. That's your expected return. It's the reward you are hoping to get.
But you know, a cricket match is not won by just one player. It is about the whole team. So your whole portfolio also has an expected portfolio return. Now, this phrase, weighted average, sounds complicated, but it's very simple. It just means that if you put more of your money on one player, his score will have a bigger effect on the team's total score. That's all.
So let me ask you a very simple question. If you want to win the match, you want to score many, many runs, would you pick players with a high batting average or a low one? Of course, a high one. So step 1 for our team is to look for players who can score big. We look for high rewards.
But wait 1 minute. Is a high batting average the only thing that matters? What if your star player is not very consistent? And this brings us to our second and very, very important idea: risk.
We've all seen these kinds of players, haven't we? One day, amazing century, he is a hero. The very next day, he's out for a duck. This big swing from hero to zero. This is exactly what we call risk in the world of finance, and the fancy word for it is variance.
So, variance is just a way to measure how much a player's score jumps up and down away from his average. A player with a high variance is, well, he's unpredictable. His score is all over the place. A big variance number just means more risk. And for a captain, that means more tension.
Look here. This is a perfect way to understand. On one side, we have the reliable player. You know he will get you a good 30 or 40 runs, almost every time. You can count on him. On the other side, you have the superstar. He might win you the match all by himself with 100, or he might get out on the very first ball. He is high risk, but also high reward. So tell me, if you are a captain who does not like too many surprises, you want a good, steady team, which player would make you feel safer? The reliable one or the unpredictable one? You see, most captains would feel safer with the low variance player because he brings consistency. Now we come to the most beautiful part of building a team. It's not just about picking individual star players. No. It is about how they play together. It's about teamwork. And in finance, This amazing idea is called diversification.
Just think about it for a minute. What if all of your batsmen are fantastic players on a dry, sunny pitch, but the moment it starts to rain and the pitch gets wet, they all get out, one by one? Oh, that would be a very, very risky team. You need a mix, right? You need some players who are good in the sun and some who are good in the rain. This is the secret to a strong team.
So how do we measure this teamwork? How do we know if players will work well together? Well, there's a special number for this, and it is called correlation. Now don't worry about the word. Think of it like this. If the number is a big +1, it means the two players are like identical twins. If one scores, the other scores. If one fails, the other also fails. But what if the number is a -1? Now that means they are total opposites. When one is having a bad day, the other one is having a fantastic day. So for good teamwork, we want players who have a low number, because then they balance each other out. You see?
Now, look at this table. It shows how this works with real investments. Let's look at the number between bonds and the S&P 500. It's only 0.25. That is a nice, low number, and that is very good news for us. It means they don't always go up and down together. When one is having a tough time, the other one might be doing just fine. This is what teamwork looks like for reducing our total risk.
And this is the real magic. When you put together investments that are not moving like identical twins, the overall risk of your whole team goes down. This is the diversification benefit. It means you can try to get the same good score, but with much, much less risk. Truly, this is the most important lesson for any new investor.
Okay, but what if your main goal is not just about winning? What if it's about making sure you absolutely do not lose? Well, for investors who think like this, there's a special rule. It is called the safety first rule. This rule is for the very careful captain. For this captain, the first thought is not how many runs can we score. No. The first thought is we must not fall below a minimum score. It's about protecting your money first, always.
So how does it work? It's just 3 simple steps. First, you decide your minimum score, the score you cannot go below. Second, for every team you are thinking about, you calculate a special number called the safety first ratio. And third, you just pick the team that has the highest ratio. That's it. That team is your safest bet.
Just look at this chart here. It makes the choice so easy. We have 3 possible teams, A, B, and C. And we have calculated their safety first ratios. Which bar is the tallest? It's Team B, right? It has the highest number, 0.91. So for the captain who wants safety first, Team B is the clear winner. It's the best choice to protect your portfolio.
So let's just quickly revise what we have learned today. Expected return, that is your batting average, your reward. Variance, that is the player's inconsistency, your risk. Low correlation, that means good teamwork, having players who balance each other. And the most important thing of all, diversification, which means building a team with a good mix. That is your best friend.
Shabash, students! Very well done. These ideas, are things that financial experts study for many years. And today, you have understood the main ideas in just a few minutes. You should be very proud of yourselves. You now have a very good foundation for building a smart investment portfolio.
So, I will leave you with one final question to think about. The next time you think about your money, about investing, will you be tempted to put everything on just one superstar player who is very risky, or will you be a wise captain and build a balanced team? A team that can win for you in both the sunshine and the rain. You think about.
Hello and welcome everyone. Today we're going to talk about something that sounds very complicated, simulation, but is actually a surprisingly simple way to guess the future. It's a really powerful tool, so let's begin, shall we?
Okay, so let's start with the big question. A very big question, isn't it? How can we possibly predict a stock's price? The future is so uncertain. It's like trying to guess the score of a cricket match that will be played next month. We don't know for sure.
But in finance, we have some very clever ways to make really good, educated guesses.
Now here is the secret, and it's very important. We're not trying to be astrologers here. We don't have a crystal ball to find one single perfect answer. That's just impossible. Instead, our main goal is to understand all the different things that could happen. This way, you see, we are prepared for anything. It's about seeing the whole map, not just trying to find one single road.
To understand stock prices, we will first take a little help from our favorite game. Yes, cricket. It will help us understand a very, very important idea. So, let's get started.
Okay, I want you to imagine all the students in a classroom. Your classroom. If we measure everyone's height, what will we find? We will see that most students are around an average height. A few will be very tall, and a few will be a bit short. And if you make a chart of this, it will look like a beautiful, smooth bell. Symmetrical. This is what we call a normal distribution. Simple, right?
But here is the problem. A stock's price cannot be like a student's height. Think about it. A stock price can be 100 rupees, it can be 10 rupees, but can it be minus 50 rupees? No, never. It's impossible. The lowest a stock price can go is 0. So, you see, we need a different kind of chart, a different model, and for that, we use something called a log-normal distribution. The most important thing to remember is this: log-normal values are always positive, always more than 0.
Let's go back to our cricket example. Think of a great batsman, maybe Virat Kohli. In most matches, he'll score a good 30, 40, or 50 runs. But sometimes he hits a double century, a huge score. Now that one very big score pulls his whole average up. This is what a log-normal distribution looks like. It is not symmetrical like a bell. It has a long tail going to the right because of those few very high scores. Stock prices behave in exactly the same way. Most days they move a little bit, but sometimes they can jump very, very high.
So let me ask you a small question to check. Why do we use this log-normal model for stocks? Is it because they can jump very high sometimes, or is it because they can never ever be a negative number, less than 0? Well, it's actually both. It's a much better fit for how prices work in the real world.
Excellent work! Now that we understand the shape of stock price possibilities, let's learn about a tool that helps us see all those possibilities. You can think of it as a what-if machine. A machine that can play out thousands of different futures for us.
This machine is called a Monte Carlo simulation. Such a fancy name, no? But the idea, I promise you, is very simple. Imagine a small shopkeeper who wants to guess his sales for next month. He knows that usually he sells about 100 bags of rice, but sometimes it's 80, and during a festival, maybe it's 150. He can put these rules into a computer and tell it, "Okay, computer, run a game for me. Show me 1,000 different possibilities for next month's sales based on my rules." That is exactly what a Monte Carlo simulation does. And the process is very simple, really. First, we define our goal. Then, we set the rules of the game, just like our shopkeeper did. Then, the computer just generates random numbers. It's like rolling the dice and runs one possible future. Then it does it again and again, thousands of times. And finally, we look at all the results together.
And this is what we get at the end. Look at this chart. It is not giving us one single price. It is showing us a map of possibilities. It's telling us that most of the time, the price will probably land here, in this big middle section. But it also shows us there is a small chance it could be very high and a small chance it could be very low. Now, we don't know the future for sure, but now we understand the risk. We are prepared.
So,
a quick question for you. After doing all this, will we know the exact future price, or will we just have a better idea of the range of possible prices? Yes, exactly. It's about understanding the range. The power of this is not about finding one magic number. It's about seeing the whole picture of what is possible.
Okay, now, what if we don't have a formula? What if our shopkeeper doesn't know the rules of the game? Don't worry, there is another very clever method, a kind of shortcut. You can even call it a jugad for when you only have past information.
This method is called bootstrapping. Let's go back to our shopkeeper. This time he has no formula for his sales. All he has is his old account book, his Bahi Kata, with all the sales figures from the last 365 days. So what can he do? He can take all 365 of those sales figures, put them in a box, and then randomly pick out 30 numbers to create a fake next month. Then he puts them all back and does it again, and again, thousands and thousands of times. He is creating future possibilities using only his real, historical data. That is bootstrapping.
So what is the main difference here? It's very simple. Monte Carlo uses a formula, a model that we give it. It is like having a recipe to cook a dish. Bootstrapping does not use a formula. It uses the actual historical data. It's like looking at all the meals you cooked last year to guess what you might cook next month. So, one uses a recipe, the other uses your old diary.
So, just to be clear, which method uses the past data, like the shopkeeper's old diary? Is it Monte Carlo or is it bootstrapping? Yes, it is bootstrapping. You are getting it perfectly. When you have a formula, you use Monte Carlo. When all you have is past data, you use bootstrapping.
We have covered a lot of ground. Now, let's put it all together. What is the most important lesson that we should take home with us today?
Okay, a quick summary. We started with why stock prices follow that special log-normal shape. It's because they can never be negative. Then we looked at two amazing tools, Monte Carlo, which uses a model to create futures, and bootstrapping, which uses past data to do the same thing. But the biggest lesson, the most important thing to remember, is that neither of these tools is a crystal ball. They are here to help us understand possibilities and manage risk.
And look at this quote. It says it perfectly. These methods are a complement. They are a helping hand. They provide statistical estimates, good guesses, not exact guaranteed results. They are maps to help us find our way, not a guarantee of what we will find at the destination.
So, I will leave you with one final thought to think about. We have these very powerful tools that can show us thousands of different roads into the future. But at the end of the day, we still have to choose just one single path to walk on. So, how do we make that choice? Well, that is the real challenge, and maybe the true art of investing. Thank you for listening so patiently.
Namaste, my dear students. Come, sit down. Today we are going to learn a wonderful, wonderful secret. It's about how we can understand very big things just by looking at a few small parts. It's almost like having a superpower, you know? A superpower to see the whole picture. So, are you ready? Let's begin.
Okay, now, just imagine, your mother is in the kitchen cooking a huge handi of biryani for a festival. How does she know if it's perfectly cooked? Does she taste every single grain of rice? No, of course not, Beta. That would be silly. She just takes one small spoon, right? Tastes a few grains, and from that tiny little taste, she knows everything about the whole pot. So simple, right? So, in our lesson today, that whole big pot of biryani, that is what we are going to call the population. And that small spoon she tastes, That is our sample. You see, in finance and business and life, we cannot always check the entire population. It would take far too much time and far too much money. So what do? We take a small, smart sample, just like tasting the biryani.
Okay, so first things first. Let us understand this properly. Why do we even need to take these small samples? Why do we make these smart guesses in the first place?
Well, taking a sample is really like taking a clever shortcut. It saves us so much time and money. But we must be honest with ourselves. What if the one spoon of biryani that Amma tasted had just a little less salt than the rest of the pot? It's possible. This small little difference, this potential difference between our sample and the whole population, we call that sampling error. Now, it doesn't mean we made a mistake. It just means our guess might not be 100% perfect.
Now, because our guess might not be perfect, how we choose our sample becomes very, very important. A wise choice gives us a much, much better guess. Let's see how we can do that.
You see, there are two main ways to choose. The first one is the fair way. Think of it like a lottery, a lucky draw for choosing the school cricket team. We put everyone's name in a box, and each and every student has an equal chance to be picked. This is very fair. The other way is the easy way. This is like the team captain just picking all his best friends for the team. It is easy, for sure. It is fast, but tell me, is it fair to everyone else? No, and it may not give you the best team to represent the whole school.
So let me ask you a question. Think about it properly. If a TV channel wants to know who will win the election for all of India, but they only ask people in Mumbai, is that a fair way or an easy way? Exactly. It is the easy way. The people in Mumbai might think very differently from people in a small village in Punjab or a town in Kerala. So our sample would not represent the whole population of India at all.
So, here is a much smarter, fair way. It's called stratified sampling. First, what we do is we divide all of India's voters into smaller groups, like big cities, small towns, villages. Then, we randomly pick some people from each of those groups. When we combine all of them together, our final sample becomes like a mini India. It's much more accurate. Have you understand? Good.
All right, now for the most exciting part. I promise you, this part is like magic, I tell you. We are going to see how even messy, completely unpredictable things can become very, very predictable when we look at them in just the right way. Let's imagine our favorite cricketer. Let's say Virat Kohli. In one match, he is brilliant. He scores a century, 100 runs. But in the very next match, oh dear, he's out for a duck, 0. His individual scores are just all over the place. It is so hard to predict what he will score in the next match, isn't it?
And if we make a chart of his scores for just a few matches, it will look something like this. You see? Up, down, way down. It's very messy. There's no pattern at all. It is completely unpredictable.
But now watch the magic. What if we don't look at just one score at a time? What if we take a sample of, say, 10 of his scores and we find the average, and then we do this again and again? Suddenly, a pattern starts to appear. The averages are not so wild anymore. They are much closer to each other, more in the center. The mess is becoming organized.
And now, for the final step. If we take many, many large samples, say the averages of 30 innings each time, something truly magical happens. The chart of these averages will always form this beautiful, symmetric shape. We call it a bell curve. So predictable and so beautiful. This magic, it has a special name. It is called the central limit theorem. And believe me, it is one of the most powerful, most important ideas in the whole world. It tells us that No matter how crazy and unpredictable the population is, like our cricketers' scores, the distribution of its sample averages will always be predictable. It will always be normal as long as our samples are large enough. This is the crucial point to remember.
So, you might be asking, Teacher, what is the use of this magic bell curve? Well, this magic is what gives us confidence. It helps us understand exactly how good our smart guess really is. We have a special number for this, and it is called the standard error. Now, don't worry about the name. Just think of it like a score for your guess. If the standard error is a small number, it means your guess is very good, very precise. It means your 1 spoon of biryani was very, very close to the taste of the whole pot. But a big number means your guess is not so precise. So, we always want a small standard error. Simple, yes?
And this is why smart guessing is so important. Really, it's used everywhere. From predicting election results, like we discussed, to a big factory checking thousands of light bulbs without having to test each and every one. It helps people understand how the stock market is performing, and it allows auditors to check a big company's accounts without looking at every single bill. It's the secret to making sense of a very, very big world. So, my dear students, what did we learn today? We learned that the world is a very big and complex place. But we don't have to be afraid of that. Because with the power of smart samples and with the beautiful, beautiful magic of averages, you now have a special tool to understand it. You have the power to make a very good guess about the whole world just by looking at a small part. So please, never stop being curious and never, ever stop asking questions. Keep learning, okay?
Namaste, bachcho. Welcome. Today, we are not going to study a difficult lesson from a big book. No. Today, I am going to teach you a secret method, a powerful tool to find out if any claim someone makes is actually true. Think of it like being a detective for numbers. Okay, let's start with this. Imagine your friend Rohan comes to you. He's very, very excited. He says, "Look at my new bat. It's a magic bat. I am scoring so many more runs with it." But how do we know for sure? Is the bat really special, or did he just have a few lucky days on the field? This is exactly the kind of question our secret method can answer. So, here is our plan for today's investigation. We will learn how to ask the right question, then we'll follow 6 simple steps to find the clues, and then we'll learn how to make a decision. We'll even talk about the mistakes a detective can make. And by the end, you'll see why all of this matters for everything, even your own money. First, Section 1, a simple, important question. Now, before we play any game, we must first understand the rules, no? Whether it's cricket or it's Ludo, well, hypothesis testing is just like that. It's a game for finding the truth. And first, we must learn its 2 very simple rules. The first rule is called the null hypothesis. Now, null just means 0, nothing. So think of this as the nothing new is happening idea. It's the boring default situation. For your friend's cricket bat, the null hypothesis is simply, this bat is just a normal bat. It makes no difference at all. It is the world as we already know it. And the second rule is the alternative hypothesis. This is the new exciting claim. This is what your friend Rohan is saying. My new bat is magic. It really does improve my score. So the alternative hypothesis is the new idea that we want to test. It's the whole reason we are doing all this detective work. So let's look at this simply. On one side, we have the null hypothesis. The world as it is. It's the boring story. You see the word bore here. On the other side is the alternative hypothesis, the exciting story that something new and interesting has happened. One is the old belief, the other is the new claim. That is the choice we must make, isn't it? So let's move to Section 2 and see how we do that. The 6 steps to find truth. Now that we have our 2 stories, the boring one and the exciting one, how do we decide which one is true? Well, we have a simple recipe, just like making a perfect cup of chai. There are 6 easy steps to follow. Here is our 6-step recipe. First, we state our 2 stories, the boring one and the exciting one. Then we choose our method and decide how much proof we need. After that, we collect our data, do the calculation, and finally, we make our decision. Let's see how this works with a real story. Okay, section 3, making the correct decision. Enough of theory, let's see this in action. Let me tell you a story about a company. We'll just call it Wilco. They came and made a big, exciting claim about how much money they were making. The managers at Wilco are shouting from the rooftops. They're saying, "We have found new ways to work. Our profits are now much more than the old average of 24 million. This is their exciting claim, their alternative hypothesis. So what is the boring, null hypothesis here? Simple, no? It's that their profit is still 24 million, or maybe even less. Now, to believe such a big claim, we need strong proof. Think of it like a school exam. For Wilco to pass this test and convince us, their evidence needs to score higher than 2.151. This number is our pass mark. Remember this number. Anything less, and they fail our test. So we took all of their data. We did the calculations, just like a teacher marking an exam paper. And after all the checking, what score did Wilco's proof get? It got a score of 1.47. Now everyone look carefully, Beta. On the left is Wilco's score, 1.47. On the right is the required pass mark, more than 2.015. So, you tell me, is 1.47 bigger than 2.015? Did they pass the exam? No, they did not. So now we make our decision. We say we failed to reject the null hypothesis. I know it sounds a little complicated, but it is very simple. It just means we are sticking with the boring story for now. We are not saying Wilco is wrong. We are just saying your proof is not strong enough for us to believe your big, exciting claim. You need more evidence. All right, moving on to section 4, the 2 types of mistakes. Now, in this detective game, are we always right? No. Sometimes we can make a mistake. It is just like in cricket. No, even the best umpire in the world can sometimes make a wrong decision. And there are 2 types of mistakes we must be very, very careful about. Let's understand these 2 mistakes with a doctor. A type 1 error is when you believe the exciting story, but it's actually false. This is like a doctor telling a perfectly healthy person they are very sick. This causes a lot of unnecessary worry. A type 2 error is when you stick with the boring story, but the exciting one is actually true. This is like a doctor telling a very sick person, "Don't worry, you are perfectly fine." This is much more dangerous, no? You must understand there is a trade-off here. If we are very, very careful not to make the first mistake, we might end up making the second mistake more often. It is a balancing act. So what is the solution? Well, the best way to be more sure and to make fewer mistakes of both kinds is to collect more data, more information, just like an umpire using the third umpire review to be absolutely sure. And now, our final and most important section, why this matters for your money. We have talked about cricket bats and company profits, but how does this secret method help you make smart decisions with your own money? Let's see how we can use this for something called a mutual fund. Okay, look at this table. A mutual fund manager, someone who invests money for many people, claims he is special. He says his fund's performance is different from what is normally expected. That is his exciting claim. So we put him to the test. And look, his score is only 0.54, but the pass mark for this test was very high, more than 2.069. So, did he pass? No. And so, what is our decision? We failed to reject the null hypothesis. Now, the formal conclusion sounds very complicated, but let me translate it for you. All it is saying is this: children, we are not sure this fund manager is special. His proof is not strong enough. His good performance might just be good luck. You see,
Our secret method helps us see past the big claims and find out what is real.
So today you have learned a powerful secret, a tool that lets you test any claim, any new idea, and not just in finance, but in your whole life. You are all truth detectives now. So I leave you with one question to think about. Now that you know this powerful secret, what belief in your life would you want to test? Think about it.
Namaste, students. Welcome to our class today. We are going to learn something very simple, but let me tell you, it is very, very important. We are all going to become detectives, you see, and learn how to find out if two things are really, truly connected. Okay, let's get started.
You know, just think about this for a moment. Does a good monsoon always mean the stock market will go up? Or let's say your favorite cricketer, maybe Virat Kohli, scores a century. Does that mean you will get better marks in your exam? Sometimes, things just happen at the same time by pure chance, just by luck. Today, we will learn how to check, is a connection real or is it just a coincidence?
So just like I write on the blackboard in class, here is our plan for today. First, we will ask that big question. Then, we will learn about 3 special tools that help us find the answer. And at the end, we will understand why these tools are so very useful for you in your life.
Right. So, in finance and, even when we are managing our money at home, we always want to know if two things are related. For example, if the price of petrol goes up, does the cost of our vegetables at the market also go up? Knowing these connections, you see, helps us make much smarter decisions with our money.
Now, to check for a connection, we use a special idea. It's called a hypothesis. The best way to understand it is to think of a cricket umpire. What is his first thought when there is a big appeal? He always assumes the batsman is not out. That's the starting belief. To change his mind and declare the batsman out, the bowling team must show very strong proof, isn't it? This starting belief, that there is no connection, is what we call the null hypothesis. Our job is to find enough proof to make the umpire change his mind.
So, how do we find this proof? Well, we use special tools. Our very first tool is, it's like a simple ruler. We use this when our numbers are normal and well-behaved, with no big shocks or surprises.
Just imagine a perfectly flat, smooth cricket pitch. Measuring things there is very easy, very predictable. That's when we use our first tool, the ruler. But what if the pitch is bumpy and completely uneven? What if you are looking at cricket scores where one batsman gets a duck, a big 0, and another one scores a double century? The numbers are all over the place. For this kind of tricky data, we need a special tool. We'll get to that one in a little bit.
Now, you will see a formula on the screen. Don't worry, Butcho, no need to get scared of the maths. All this complicated-looking formula does is give us one single number, just one. We will call this our test score. Think of it as the score our team has made.
So, how do we get this test score? It's very simple, really. First, we just measure how strong the connection seems to be. Then, we see how much data we have collected, and just like that, the formula gives us our final test score. The last step is the most important one. We compare our score to a special score written in the umpire's rulebook. If our score is bigger, we win. Let's take a real example, okay? An analyst, that's someone who studies money for a living, looked at 2 different investments for 33 long years. He wanted to know, are the profits from these 2 investments related to each other?
So, after using our ruler tool and that formula, he calculated his test score. And the score, the evidence that we showed to the umpire, was 2.65. Okay, so now we have our score. We then check the umpire's rulebook. For this particular situation, the rulebook says that any score above 2.45 is the target. That's the score we need to beat.
And look, our score is 2.65, and the rulebook score is 2.45. Our score is higher. So what does the umpire do? He raises his finger. Out. We have proved it.
The connection between the two investments is real. It is not just luck.
Simple. No, it's just like a cricket match. If our score is bigger than the target score, we win. And winning, in this case, means we have found a real connection. Does that make sense? I hope so. Let's keep going.
Okay, very good. Now, what happens if our data is not so simple? What if the numbers are tricky, like on that bumpy, uneven cricket pitch we talked about? Well, for that, we need a special tool.
Now, what's really interesting about this tool is it doesn't even care about the actual scores. It's very clever. It just puts all the numbers in order, from the biggest to the smallest. Just like a teacher ranks the students in the class, first rank, second rank, third rank, and so on. It makes all the tricky numbers simple just by ranking them.
So, another analyst used this special ranking tool on some very tricky investment data. This time, the test score he got was very, very high, 5.50.
And what does the rulebook say for this test? It says the score to beat is just 2.03. So once again, our score of 5.50 is much, much higher than the rulebook score of 2.03. So the umpire's decision is clear. Out. The connection is definitely real. So you see, Baccio, even with a different tool, the process, the thinking, is exactly the same.
Now on to our third and final tool for today. This one is a little different. It is not for numbers that you can measure, but for putting things into different groups or boxes. We call these categories.
Just look at this table. It's like a shopkeeper who is sorting his items. He has sorted all these investment funds by their size, small, medium, or large, and also by their type, value, growth, or blend. The big question is this: is there a connection between the size of a fund and its type? Are they related somehow?
To answer this, our tool compares two things. First, what we actually see in the table, we call this observed. And second, what we would expect to see if there was absolutely no connection at all. It's like when you do a mobile recharge, you expect to get, let's say, 2 GB of data for 100 rupees, but the amount you actually get, that is the observed amount. This tool just checks for the difference.
So, we calculate a new test score that measures the surprise. How different is what we saw from what we expected? For our example, the surprise score is very high, 32.08.
And what does the umpire's rulebook say? It says the surprise needs to be bigger than 9.49 for it to be real, and not just some coincidence. Our score of 32 is much, much bigger than 9.49. So again, the umpire's decision is out. The size and type of funds are definitely related.
So now that we have seen our three tools in action, let's just take a moment to understand why this all matters to you. You have a new financial toolbox now.
The crucial point is this: you now have a financial detective kit. You have a simple ruler for your normal, everyday numbers. You have a special tool for those tricky, uneven numbers that works by ranking them. And you have a sorting tool for checking connections when you put things into groups.
And this is the main thing I want you to remember, my students. These tools are not just for your exams. They help you look at the world around you and see the difference between a real connection, a real pattern, and something that is just pure luck. Using them makes you a smarter investor. Yes, but more importantly, it makes you a smarter thinker in your everyday life.
So now, I have a question for you. Now that you are all smart data detectives, what connections in your own life will you investigate? Think about it. Thank you for your attention today, and I will see you all in the next class.
Namaste, students. Welcome. Today, we are going to learn a simple but, a very powerful secret. It's the kind of secret that big experts use to predict things, to make smart guesses about the future. But please, don't worry. It is not difficult at all. It's actually quite fun, almost like we're solving a puzzle together. So, are you ready? Let's begin. Okay, just imagine for a moment. You have a small shop, and you're selling ice cream. Now, how can you possibly guess how many ice creams you will sell tomorrow? Will it be 10 or maybe 100? It's a puzzle, no? Well, the secret is to find a connection between something you already know, like, say, the weather, and something you want to know, like your sales tomorrow. The hotter it gets, the more ice cream people buy. See? It's simple, isn't it? So, this is the main point. The whole idea is this. We are using one thing we can see and measure right now to make a smart guess, a good prediction about something we can't see yet. This is the big secret. You know all those serious financial analysts you see on TV? This is what they're doing. But the idea itself, Beta, is very, very simple. It's like a game we're all going to learn to play today. Right. So, before we can make our guess, we first need to understand the two things we're trying to connect. You can think of it like a drawing book, where you connect the dots to make a nice picture. First things first, we need to find our dots. Okay, our first dot, this is the thing we want to guess. The big question mark. In our little shop, it's the number of ice creams we're going to sell. We have a special name for this. We call it the dependent variable. Now, why dependent? Simple. Because it depends on something else, like the hot weather. It can't decide on its own. Simple, no? This is the answer we are looking for. And the other thing, the one that helps us guess, that is called the independent variable. So in our example, that's the temperature outside. It doesn't depend on how many ice creams we sell, does it? The sun will be hot no matter what. It is independent, you see. It just stands on its own. And we use its help to make our guess. Okay, now let's look at some other examples to make this very, very clear. A company's profit. Well, that might depend on how much it spends on new machines. A cricketer's final score. That probably depends on how many balls he has faced, right? And your exam marks. Well, they definitely depend on how many hours you studied. See? In each case, one thing helps us guess the other. So, a quick question for all of you. Let's see. If we want to predict a company's profit using its spending, which one is the dependent variable? Just think about it for a second. Yes, the profit, because the company's profit depends on how much it's spending. Shabash, very good. You are all learning so well. Excellent. So now we have our dots, right? We have the dependent and the independent variables. So what's next? Now we are going to take all our information, all our dots, and draw a special line. You can think of it as a magic line that will help us make our guess. Now look here. This is real information from our source. For 6 different companies, we have their spending and we have their profit scorecard. Think of each company as one single dot. You see? Company A spent very little and its scorecard was low. But Company F, it spent a lot and its scorecard was very high. So now we have our collection of dots. Now, we draw a straight line right through these dots. This is our magic line. The proper name for it is a regression line. Now, this line, it doesn't have to touch every single dot perfectly, but it passes as close as possible to all of them. It shows us the main path. You could say the average relationship between all the spending and all the profit. You see, our magic line has to start somewhere, doesn't it? And this starting point has a name. It's called the intercept. For our companies, the intercept is 4.875%. Just think of it like a base score, a starting score. It means that even if a company has 0 spending, our guess for its profit scorecard would start right here. It's the base level. And how steep is our line? Well, that's called the slope. And for every 1% more a company spends, we guess that its profit scorecard will go up by 1.25%. The slope tells us the direction. Is it going up or down? And it tells us the speed of our guess. It's really the engine of our whole prediction machine. Okay, so we have connected our dots. We have drawn our magic line. And we have a guess. But is it a good guess? Is it like Sachin Tendulkar's batting? Very reliable? Or is it just a wild guess? We need a report card for our prediction, isn't it? We need to know how well we did. So to grade our guess, we use a very special score. It is called R-squared. Just think of it like the marks you get in your final exam. It tells us how well our independent variable, the spending, is able to explain the story of our dependent variable, the profit. A high score is very good, and a low score is, well, not so good. And for our example, our model scored 80.01%. Wow! That is like getting distinction in your board exams, an A grade. This is a very, very good score. It means that 80% of the changes in a company's profit can be explained by its spending. That tells us our guess is actually very strong. Now, just to be sure we all understand, what if our R-squared score was very low? Let's say only 10%. What would that mean? Well, it would mean our guess isn't very good. It would tell us that a company's spending doesn't really explain its profit very well at all. Maybe something else, like good management or a popular new product, is much more important. A low score just tells us we need to look for a better connection. So, today we have learned a secret. But this secret is not just for big companies or for financial experts on TV. No. It is a way of thinking. It's a tool that you can use too. Let's just quickly remember the simple steps we took together. Remember, we learned that we can predict one thing using another thing we already know. We find the dependent and the independent variables. Then we draw our magic line, the regression line, to see the average connection. And finally, we get a report card for our guess with a score called R-squared. You have all learned so much today. And look, this is not just my teaching. The source material for this whole explainer, written by a very smart professor, Pamela Peterson Drake, says it perfectly. Regression allows us to use one variable to make predictions about another. That's it. That is the simple, powerful secret. So, my dear students, now you know the secret. You have a new power, a new way of looking at the world and making smart guesses. So my final question to you is this. Now that you know this little secret of prediction, what would you like to predict? Think about it. The possibilities are everywhere around you. Well done today.
Hello, everyone, and welcome. I am so glad you are here today. We are going to learn about something very, very interesting, something that is changing all of our lives, the technology that is inside our mobile apps.
Now, I know we are going to talk about some big-sounding words today, words like fintech and big data, but please, don't you worry. We will go very slowly, and we will break everything down one step at a time. I promise you, by the end, you will see how it all connects.
Just think about it for a second. With just a few taps on your phone, you can do so many things that before it used to take so much time. It feels almost like magic, no? Well, today, we're going to understand that magic.
Okay, so let's start with our first big word for today. You might have heard people say this word, fintech. So what is this fintech? Let's break it down and see what it really means.
Okay, now look at this definition. It sounds very complicated now. Technological innovation. I use so many big words. But really, it's just a fancy way of saying we are using technology for our money matters. See? Finance plus technology, that becomes fintech. It is that simple.
Yes, exactly. Just think about the old days. If you wanted to send some money home to your family, you had to go to the bank, fill out so many forms, and wait in a long, long line. But now you can just sit at home, on your sofa, open an app, and click send. That easy process, that is fintech in action.
So let me ask you a question. When you use an app to recharge your mobile phone, is that an example of fintech? What do you think? Yes, of course it is. You are using technology for a money transaction. So yes, that is also fintech.
Very good. Okay, so for these fintech apps to work so smartly, they need some fuel. And that fuel is information. And I don't mean a little bit of information, I mean a giant, giant ocean of it. And this ocean has a special name. We call it big data.
Again, this is a very simple idea with a big-sounding name. Every time you use your phone, every time you search for something on the internet, information is created. Big data is just the name for all of this huge amount of information being collected.
You know your local shopkeeper, your Kirana store uncle? He has a small notebook, a khata book, with everyone's accounts. That is data, yes, but it is small. Now, imagine a library so big, it has the score of every single ball from every cricket match ever played in the whole world. All the runs, the wickets, everything. That huge collection, that is what we mean by big data. See the difference?
Now, to really understand what makes data big, we can think about it in 3 ways. We call them the 3 V's. It's very simple. The first V is for volume. That's how much data there is. The second V is for velocity. That's how fast the data is coming. And the third V is for variety, meaning all the different types of data. Let's look at each one, okay?
So, volume is just about the size. Just imagine trying to count the total number of runs scored in all the IPL matches ever played, combined. It's a huge, huge number, right? That is volume. Now, velocity is about speed. When you are watching a match, the score updates instantly, nah? After every single ball. That super fast speed of new information coming in, that is velocity.
And finally, variety. You see, in a cricket match, the information is not just the numbers on the scoreboard. It is also the photos of the players, the videos of the big sixes, and all the comments that fans are writing online. All these different types, numbers, pictures, videos, words, this is variety.
Okay, a quick question for you. When a new big movie releases, social media posts explode every second. When we talk about the speed of these posts, which V are we talking about? Yes, since we're talking about the speed, that's velocity. See, you're getting this.
So, we have this giant ocean of big data. But how do we make any sense of it? No human can read everything. It's impossible. So we need some very smart helpers. These helpers are called artificial intelligence, or AI, and machine learning. Artificial intelligence, or AI, is just about making computers smart. We want them to do tasks that normally a human being would do, like understanding what we are saying or recognizing a photo.
So how do we make computers smart? Well, that is where machine learning comes in. It is how we teach the computer. We don't give it rules for everything. No. Instead, we give it lots and lots of examples, and it learns the rules by itself. The whole idea of machine learning can be said in one small sentence. Find the pattern, apply the pattern. The computer looks through all the data to find a pattern, and then it applies that same pattern to new data it has never seen before. Find the pattern, apply the pattern. That's it. Think of it just like school. First, the teacher gives you lots of examples. We call this training. Then, the teacher gives you some homework to check your understanding. We call this validation. And finally, you get a final exam with new questions. That is the test. It is the same process for computers. It's just like teaching a small child to recognize different dolls at home. You don't write down rules for what Moon doll looks like. You just show them examples. You show them Masur, you show them Tur, again and again. And eventually, the child just learns. Machine learning works on the same idea. But you know, a lot of big data is not in numbers. It's in words. So we need one more smart helper, a specialist that helps computers understand our human language. This is called natural language processing, or NLP. Just think how powerful this is. A company can use NLP to read millions of customer reviews in minutes and understand if people are happy, or angry, or confused. A team of people could never work that fast. That is the power of NLP. So, let's quickly recap what we have covered. Fintech is technology for money.
Big data is the huge ocean of information it uses. Machine learning teaches computers to find patterns in that data, and NLP helps them understand our words. See? Not so difficult.
And now I will leave you with a question to think about. You now understand the basic tools that are changing our world. So think for a moment. What small problem in your own life or in your community do you think could be solved with this magic of fintech, big data, and AI? The possibilities are truly endless. Thank you for learning with me today.